In 1 week, the cattle market lost $30 a hundredweight. Not because of a drought, not because of disease spreading through American herds, because of 6 words from a government press release. The border is reopening. For most people, that sentence means nothing. Borders open and close all the time. Trade deals get signed, trade deals get suspended, tariffs go up, tariffs come down. The world keeps turning. But for the people who raise cattle in Texas, New Mexico, and Arizona, that sentence hit like a shockwave. Because this wasn't just any border, and this wasn't just any trade. This was the line between Mexico and the United States, and the thing crossing it was cattle. Millions of them every single year, feeding an entire economy that most Americans never think about until the price of a steak jumps at the grocery store. To understand why one government announcement could crash a market overnight, you have to go back more than a year to a decision that quietly reshaped an entire industry. In April 2025, the United States closed its southern border to cattle imports from Mexico, not because of politics, not because of a trade war, because of a parasite most Americans had never heard of, the New World screwworm. The name alone tells you most of what you need to know. It's not a worm in the way you'd picture one. It's the larval stage of a fly, and it doesn't wait for a wound to happen naturally. The female fly lays her eggs directly into any open cut, scrape, or soft tissue on a living animal, sometimes even in the nostrils or the navel of a newborn calf. When those eggs hatch, the larvae do exactly what their name suggests. They screw themselves into living flesh, feeding on it, burrowing deeper, and multiplying the wound as they go, left untreated. An infestation can kill a full-grown animal within days. It's brutal, it's fast, and once it gets a foothold, it's incredibly difficult to eliminate. The United States spent decades and a fortune eradicating this parasite from its own soil, using a program that released millions of sterile male flies into affected areas so females would mate without producing viable offspring. It worked. By the 1960s, screwworm was effectively gone from the U.S., pushed back through Mexico and Central America, and for generations, American ranchers operated without ever having to think about it. That changed when new cases started showing up again, working their way north through Central America and into Mexico. And by the time officials confirmed screwworm was spreading through Mexican cattle-producing regions, the United States Department of Agriculture made the call that would define the next year and a half of the American cattle industry. Close the border. No live cattle imports from Mexico, full stop, until the threat could be contained. On paper, it was a straightforward biosecurity decision. In practice, it pulled one of the most important supply lines in American agriculture right out from under the industry's feet. Here's the number that explains everything that followed. In a normal year, before any of this happened, roughly 1.2 to 1.5 million head of cattle crossed from Mexico into the United States. These weren't finished, market-ready animals. Most of them were feeder cattle, young, lean animals raised in Mexico and then shipped north to be fattened up in American feedlots before heading to slaughter. For decades, this was simply how the system worked. Mexican ranches specialized in raising calves cheaply on grass in a warmer climate, and American feedlots specialized in finishing them on grain, adding the weight and the marbling that turns a lean calf into a market-ready steer. It was a division of labor that had been built and refined over generations on both sides of the border, and entire businesses were structured around the assumption that it would keep working. Feedlots in the Southwest and the High Plains in particular leaned on Mexican cattle far more heavily than most people realized. Some operations built their entire annual inventory around it. 60-70% of the cattle passing through certain feed yards in a given year had, at some point, crossed that border. So when the border closed in April 2025, it wasn't like flipping off a light switch in one room. It was more like cutting the main power line to a whole section of the grid and then watching, month by month, as the lights started going out one building at a time. The first thing that happened was almost invisible to anyone outside the industry. Import numbers simply started falling short. Analysts who tracked these flows compared what was actually crossing the border to what should have been crossing, based on years of historical patterns, and the gap wasn't small. At the worst point of the disruption, monthly imports were running more than 150,000 head below where they should have been. That's not a minor dip. That's a hole in the supply chain that nothing else was built to fill. And feeder cattle, unlike a lot of commodities, aren't something you can just manufacture more of on short notice. A calf takes months to raise before it's even ready to be shipped anywhere. Ranchers can't simply decide 1 week to produce more supply and have it show up the next. The U.S. domestic cattle herd was already historically small going into all of this, the smallest it had been in decades, the result of years of drought, high feed costs, and ranchers gradually shrinking their herds rather than expanding them. So the timing could not have been worse. Just as domestic supply was already tight, the largest external source of feeder cattle got cut off entirely. Basic economics took over from there. Fewer cattle available, feedlots competing harder for the ones that were, and prices doing exactly what prices do when supply tightens and demand doesn't. They climbed. And they didn't climb gently. By the middle of 2025, feeder cattle prices had pushed roughly $100 per hundredweight, above where market models expected them to be, based purely on the historical relationship between supply and price. That is an enormous premium. It meant that every pound of feeder cattle moving through the system was carrying the weight of a supply shock that had nothing to do with weather, nothing to do with consumer demand, and everything to do with a parasite outbreak 600 miles south of the border and a policy decision made in response to it. For a while, higher prices might sound like good news if you're not paying close attention. Ranchers selling cattle were getting more money per head, but that framing misses almost everything that actually matters here, because the ranchers selling cattle at record prices were mostly the ones who already had cattle to sell. A shrinking group, given how small the herd already was. Meanwhile, the feedlots that needed to buy cattle to keep their operations running were paying those record prices just to stay in business, with no guarantee they'd be able to sell finished cattle for enough to cover the cost. That's the part of the story that doesn't show up in a headline number. It shows up in what happened to the feedlots themselves. In the Southwest, cattle feeding is not just an industry. It's the backbone of entire small towns and counties. Feedlots employ people directly, and they support an entire web of businesses around them, from feed suppliers to truckers to veterinarians to the diners where workers eat lunch. When a feedlot in West Texas, one that had operated for years, closed its doors, it wasn't treated as an isolated business failure. People inside the industry read it as a warning sign. This wasn't a company that failed because of bad management or bad luck. It failed because the supply chain it depended on for the majority of its inventory had simply stopped functioning, and there was no replacement for it. One independent livestock producer who has spent years working the Sonora to Arizona trade corridor put it in stark terms. The Sonoran cattle trade alone, she said, had been injecting more than $1 billion a year into the regional economy before the closure. $1 billion moving through a chain of ranchers, transporters, inspectors, feedlot operators, and everyone downstream of them. And once the border closed, that entire flow simply stopped. Producers on the Mexican side of the border weren't spared either. Sonora, in particular, had spent years building a reputation as a certified screwworm-free zone, maintaining strict biosecurity standards, specifically because so much of its economy depended on selling cattle north. From their perspective, the border closure wasn't just economically painful. It felt disconnected from the actual risk on the ground in their specific region, since the screwworm problem was concentrated much farther south and had not been detected in their certified zone. Pathway north at all, and the political and agricultural cost of getting that decision wrong was seen as far higher than the economic cost of keeping the border shut a little longer than some producers wanted. So the closure held. Through the rest of 2025 and into 2026, cattle kept not crossing the border, feedlots kept feeling the squeeze, and the entire industry existed in a kind of extended, expensive holding pattern, waiting for either the screwworm threat to be resolved or for U.S. officials to decide the situation had changed enough to justify reopening. Then, in June 2026, the situation actually did change, but not in the direction anyone in the cattle business wanted. Screwworm cases were confirmed inside the United States itself, not just approaching the border, not just detected in cattle near the border in Mexico, inside American territory. For over a year, the entire justification for the closure had rested on keeping the parasite out, on treating the border as the last line of defense. Now that line had been crossed anyway, and it forced an uncomfortable question that nobody wanted to say out loud. If the border closure hadn't actually kept the parasite out, what exactly was it still accomplishing? That question split the industry right down the middle, and it's a split that's still playing out today. On one side, groups like RCALF USA argued that the confirmed U.S. case was proof the closure needed to stay in place, not evidence it should end. Their reasoning was that reopening the border while screwworm was still active in Mexico would only increase the risk of additional infestations, compounding a problem that was already spreading rather than helping to contain it. From their view, the closure wasn't the cause of the outbreak reaching American soil. Inadequate eradication efforts in Mexico were. And loosening trade restrictions now, they argued, would be treating the symptom of economic pain while ignoring the actual disease risk that started this whole thing. On the other side, groups representing much of the broader cattle industry, including the National Cattlemen's Beef Association and regional groups like the Texas and Southwestern Cattle Raisers Association, pushed back on continued closure as a strategy that was doing real measurable damage without actually solving the underlying problem. Their argument was straightforward. The border being closed hadn't stopped screwworm from reaching the U.S. anyway, so continuing to strangle the supply chain wasn't preventing the outcome everyone feared. It had already happened. What the closure was doing, with certainty, was destroying feedlots, driving up costs for consumers, and putting long-term pressure on an industry that was already historically small and already struggling. Caught in the middle of this argument was USDA Secretary Brooke Rollins, who spent months signaling caution rather than urgency. There were public appearances, planned visits to border crossings, and repeated statements that a phased reopening was being evaluated. But for a long stretch, evaluation was all it amounted to. At one point, a planned visit to the Douglas, Arizona border crossing, one that the industry had been watching closely for signs of what might come next, was abruptly canceled with almost no explanation. Markets that had been holding their breath in anticipation of an announcement were left with nothing but more uncertainty, and traders openly said they'd rather sit on the sidelines than guess at what Washington was going to decide. That uncertainty was, in some ways, almost as damaging as the closure itself. Markets can adjust to bad news. What they struggle with is not knowing what the news is going to be. Every rumor of a reopening sent ripples through futures prices. Every delay, every canceled visit, every ambiguous statement from USDA added another layer of unpredictability onto a market that was already operating under enormous strain. And then, in late July of 2026, the wait finally ended. USDA announced a phased reopening plan. The Douglas, Arizona port of entry would begin accepting cattle again starting August 24th, with additional ports in Santa Teresa and Columbus. New Mexico expected to follow if the initial phase went smoothly. Every single animal crossing would go through full USDA inspections, specifically screening for signs of screwworm, and the whole approach was explicitly described as contingent, dependent on Mexico continuing to follow a joint action plan aimed at controlling the outbreak at its source. You would think, after more than a year of feedlots closing and ranchers pleading for exactly this kind of announcement, that the reaction would have been relief. Instead, the market did something that caught a lot of people off guard. It crashed. Deferred feeder cattle futures didn't just dip. They closed limit down, meaning they fell as far as exchange rules allowed them to fall in a single session, hitting the daily trading limit and effectively freezing further losses until the next trading day. It happened again the following Monday. October forward contracts fell the full $10.75 daily limit. Over the course of that single week, the CME Feeder Cattle Index, one of the most closely watched benchmarks in the entire industry, dropped 4%. In the weeks leading up to and following the announcement, cash cattle prices had already fallen roughly $30 per hundredweight, and boxed beef prices dropped by close to $40 as the reopening news settled into the market. To someone watching from outside the industry, this looks contradictory. The border closing broke the market by creating scarcity. So shouldn't reopening the border have fixed that by bringing supply back and easing prices in a controlled, gradual way? In theory, yes. In practice, markets rarely move gradually when they've spent over a year pricing in a shortage that suddenly looks like it's about to end. Here's what was actually happening underneath the surface. For more than a year, feeder cattle prices had baked in an enormous scarcity premium, that $100 per hundredweight gap between what prices would have been under normal conditions and what they actually were with Mexican supply cut off. Traders, feedlots, and everyone else pricing cattle in the futures. Market had built their expectations around a world where that Mexican supply stayed off the table indefinitely. The moment USDA confirmed a reopening timeline, even a cautious, phased, contingent one, that entire assumption got thrown out overnight. And when an assumption that's been propping up prices for over a year suddenly disappears, the market doesn't drift back down slowly. It repriced immediately and violently because every trader holding a position built on continued scarcity needed to adjust that position at the same time. Making the timing even worse, the reopening announcement landed in the same week as two other major pieces of USDA data: the regular monthly cattle report and a semi-annual cattle inventory report. Markets were already digesting fresh numbers on herd size and placements when the border news hit, and traders were left trying to process multiple significant pieces of information in the same trading session. Analysts who cover these markets closely describe the reaction as a kind of perfect storm, not one single bearish number driving the sell-off, but the stacked, simultaneous timing of several major pieces of news landing on top of each other, each one amplifying the reaction to the others. Some market analysts pushed back hard on the idea that the sell-off reflected a genuine fundamental repricing of where the cattle market should be. Their argument was that the move was driven more by fear and positioning than by a clear-eyed reassessment of actual supply and demand. After all, no cattle had actually crossed the border yet on the day the futures market cratered. The announcement was still just an announcement, a plan with a start date, conditions attached, and an explicit warning from USDA that openings could be paused if follow-up inspections in Sonora or Chihuahua turned up increased risk. Nothing physical had changed. What had changed was expectation, and expectations in a market that's been under this much strain for this long can move prices just as hard as reality does. There's also a piece of institutional memory working against the reopening's credibility. This wasn't the first time a reopening had been floated. Back in 2025, an earlier announced reopening never actually took effect. Plans were discussed, timelines were floated, and then nothing happened, and the border stayed closed anyway. That history left some in the industry skeptical that this latest announcement would hold up either. One cattle buyer, closely watching how the reopening news moved prices for a very specific segment of the market, Corriente cattle used in roping competitions, most of which historically came from ranches in Chihuahua, summed up the mood by saying that so much of the market's reaction was to the conversation itself, to the media coverage and the hype surrounding the announcement, rather than to any actual change on the ground. If nobody had said anything, he suggested, prices might not have moved nearly as much because, functionally, nothing had actually happened yet. That's a genuinely uncomfortable thing to sit with if you're trying to understand what's really going on here. A market that took over a year to price in a shortage, repriced almost the entire premium away in a matter of days, based entirely on the announcement of a plan that hadn't been executed yet, that came with explicit conditions attached, and that had a documented history of falling apart before. It raises a real question about how much of modern commodity pricing is driven by verified physical reality versus how much of it is driven by anticipated reality, priced in advance and then adjusted violently whenever expectations shift. For the people actually running feedlots and ranches through all of this, none of that theoretical discussion changes the very real, very immediate financial exposure they're carrying. Ranchers, who had cattle to sell during the high price period, benefited from those record prices, but many of them are also holding inventory or making forward commitments based on price expectations that just got upended. Feedlot operators who spent over a year paying inflated prices for scarce feeder cattle, hoping the eventual return of Mexican supply would ease their costs, are now watching the value of the cattle currently on feed drop sharply, even before a single new animal has crossed the border to actually increase supply. It's a strange kind of whiplash, punished by scarcity for a year, and then punished again by the anticipation of that scarcity ending. And even now, with an actual reopening date on the calendar, nothing about this is guaranteed to unfold smoothly. USDA has been explicit that the timeline will remain flexible and that individual port openings may be paused if post-opening audits reveal increased screwworm risk in the originating Mexican states. That means the industry isn't just watching a calendar date anymore. It's watching inspection reports, audit results, and the ongoing status of Mexico's own eradication and containment efforts, all of which could shift the timeline again with very little warning. There's also the deeper structural question that this entire saga has exposed, one that goes well beyond any single border crossing or any single reopening date. The U.S. cattle herd was already historically small before any of this happened. Years of drought, high input costs, and shrinking margins had pushed ranchers to reduce their herds rather than rebuild them. And rebuilding a cattle herd isn't something that happens quickly. It takes years of retaining heifers, breeding them, and waiting for calves to mature, all while carrying the cost of doing so with no guarantee that prices will stay favorable long enough to make it worthwhile. Even if the Mexican border reopens fully and stays open, it doesn't instantly fix that underlying domestic supply problem. It adds back an important piece of the supply chain, but the broader story of a smaller, tighter, more expensive American cattle herd was already in motion well before the screwworm outbreak or the border closure entered the picture, and it's expected to keep shaping prices well into the following year, regardless of what happens at any individual port of entry. For consumers, all of this eventually shows up in one place that everyone actually notices: the meat case at the grocery store. Beef prices had already been elevated for an extended stretch, a direct reflection of tighter supply working its way through the entire chain, from feeder cattle costs all the way to the finished product on the shelf. The initial drop in beef prices following the reopening announcement offered a hint of relief, but industry watchers are cautious about reading too much into it, given how much uncertainty still surrounds the actual physical resumption of trade. Prices easing on the expectation of future supply is not the same as prices easing because that supply has actually arrived and stabilized the market. It's worth pausing on just how unusual this whole sequence really is when you step back and look at the shape of it. Most commodity shocks follow a familiar arc. Something disrupts supply, prices climb, the disruption resolves, prices ease back down, and the market settles into a calmer normal. That's not what happened here. Instead, the disruption itself became the new normal for well over a year, long enough that traders, feedlots, and ranchers built their entire operating assumptions around scarcity being permanent, or at least too permanent, to plan around ending. And when that assumption cracked, it cracked all at once across the entire futures curve in a matter of days. That's the part of this story that deserves more attention than it usually gets. A market spent over a year adjusting to a shock. It took less than a week to unwind a huge portion of that adjustment based on a scheduled date and conditions that hadn't even been tested yet. If that sounds unstable, that's because it is. It says something about how modern agricultural markets actually function, not as slow reflections of physical supply and demand, but as fast-moving repositories of expectation, where announcing a plan can move prices almost as violently as executing it eventually will. There's also a quieter story underneath all of this, one that doesn't show up in futures charts or USDA press releases. It's the story of people who don't get to hedge their exposure with a phone call to a broker. Truck drivers who haul cattle across those specific crossings, many of whom saw their work dry up for over a year. Inspectors in small-town businesses in places like Douglas, Arizona, where the local economy is tied to whether livestock trucks are rolling through on a given week. For them, the reopening isn't an abstract shift in a contract. It's the difference between steady work and none, without a trading screen to tell them when things might change. None of this is to say the closure was wrong, or that the reopening is either. Biosecurity decisions involving a parasite capable of killing livestock within days aren't simple, and reasonable people, including officials closest to the situation, have disagreed sharply about where the line should sit between protecting the domestic herd and preserving relationships that keep the Southwest's agricultural economy functioning. And what's clear is that the costs of getting this wrong run in both directions. Keeping the border closed too long carries a cost, measured in shuttered feedlots and lost regional income. Reopening it carries risk too, measured in the chance that screwworm gains a foothold far more expensive to undo than a trade restriction ever was. So where does that leave things now, sitting on the other side of the announcement, but still ahead of the actual reopening date? The border is scheduled to reopen at Douglas, Arizona, in late August, contingent on continued cooperation from Mexico, under the joint action plan both governments agreed to. Additional ports may follow if that first phase goes well. Every animal crossing will be inspected, and the market, having already priced in a huge chunk of the reopening before a single head of cattle has actually crossed, is now left waiting to see whether reality lines up with what the futures market already assumed would happen. What this whole episode really reveals is how tightly connected two economies actually are, and how fragile that connection can prove to be when it's tested. A parasite outbreak in Mexico turned into feedlot closures across the American Southwest. A biosecurity decision made to protect American agriculture ended up squeezing the very ranchers and feeders it was meant to protect. And an announcement meant to ease that pressure by reopening trade instead triggered one of the sharpest single-week sell-offs the cattle futures market has seen in this entire saga. None of it moved the way a simple headline would suggest. Closing the border didn't just protect the U.S. from screwworm, it also broke a supply chain built over decades. And reopening the border didn't just fix that supply chain, at least not yet, not on paper, not while it's still just a scheduled date with conditions attached. It broke the market a second time in the opposite direction, before a single animal had even made the trip north. The full story, in the end, might not be about a border at all. It might be about how much of what we call a market is actually built on expectation, on anticipation, on collective belief about what's coming next, and how violently that belief can move in either direction the moment new information forces everyone holding a position to reconsider it all at once. The border closing broke the cattle market overnight. The border reopening broke it again. And somewhere in between those two shocks is an entire industry, an entire region, and an entire chain of ranchers, feeders, and workers who are still trying to figure out exactly where the ground is going to settle.